In 2010, the US stock market lost $1 trillion in 36 minutes. It was called the flash crash, and it was caused by high-frequency trading algorithms reacting to each other faster than humans could blink. But that was just a warm-up, because back then we were only automating the execution, the buying and the selling. Today, we're looking at automating the entire strategy. We are handing the keys of the global economy to a new type of intelligence, one that doesn't just follow rules, but learns from them. And regulators are starting to ask terrifying questions. What happens when the entire global economy is run by the same 3 or 4 AI models? What happens when they all decide at the exact same time to sell? To understand the risk, we have to understand the scale. This isn't just a few hedge funds experimenting with ChatGPT. This is a structural transformation of the entire financial ecosystem. For 40 years, Wall Street ran on what we can call Quant 1.0. These were statistical models based on historical data. They assumed that the future would look roughly the same as the past. But now we're entering Quant 2.0. We aren't just using calculators anymore. We're using deep learning and neural networks. These models are terrifyingly good. They ingest things that human traders just can't. They read earnings transcripts and unstructured market news. They analyze investor sentiment from social media in real time. And they adapt. Traditional models were static. These new agents learn through trial and error to maximize a reward, something like a Sorrentino or a Sharpe ratio. They try a strategy, they lose some money, they rewrite their own code, and then they try again. But these systems are like supercars with no brakes. We need humans just to sit in the passenger seat and supervise the machine. But the problem is, the cars are starting to drive faster than humans can see. Here's the nightmare scenario. It's not that AI is stupid. It's that AI is too similar. Regulators like to call it homogeneity risk. Right now, building a frontier AI model costs billions of dollars. That means only a few companies can actually do it. So imagine a world where thousands of different banks and hedge funds are all building their trading bots on top of the same foundational models or data providers. Basically, they're using the same brain. This is going to create a kind of hive mind. If numerous AI trading systems use common underlying data or models, they might respond to stress events in the exact same correlated way. They won't just sell, they'll stampede. And it can get even scarier. There's a theoretical risk known as algorithmic collusion. Now, we have laws against humans fixing prices, but AI models designed to maximize profit might eventually learn from each other's behavior. They never communicate, they never send an email, they just sync up. They learn that if they both hold the price high, they both win. It's kind of like invisible price fixing, and it's mathematically perfect. Now let's throw in agentic hallucinations. We know LLMs generate alpha expressions and strategies, but they also hallucinate. Let's say one agent hallucinates a bankruptcy or a false signal. It would then execute a massive sell order. The other agents, programmed to adapt to the market feedback, see the sell order, interpret it as a signal, and then they pile on. In the old days, a human trader might pause and say, wait, is that true? But an agent optimized for speed, it doesn't pause. And by the time we look up from our coffee, the liquidity has vanished. This brings us to the final problem, the black box. Deep learning models are notoriously difficult to interpret. We know the input, and we love the output, the profit, but the middle, the hidden layers, it's still a mystery. If a human trader loses billions of dollars, you can haul them into a room and ask, why did you do that? But you can't interrogate a network. It struggles to retrace precisely how it arrived at a decision. This is why the most important acronym in finance right now isn't ROI, it's XAI, Expandable AI. Expandable AI is the attempt to build a window into the black box. It's a set of processes that allows humans to comprehend the outputs of the machine learning algorithms. It generates feature attributions. It tells us, I sold Apple because interest rates went down and sentiment went down. This isn't just about curiosity, it's about control. And this gives us the insight needed to understand when to engage the kill switch. If we don't understand why the model is panic selling, we don't know how to stop it. And we won't even know if we should. We need to be able to distinguish between a real market crash and an algorithmic glitch. Without this technique, we're essentially flying a plane at supersonic speeds blindfolded while the autopilot might be having a hallucination. The financial crisis of the past, 1929, 2008, these were human-driven in nature. They were driven by fear, greed, and bad judgment. But the next crisis might look very different. It won't be a moral failure. It will be a technical one. A collision of homogeneous code, optimized for a profit target that ignores reality. We are building the most powerful financial engine in history. The question is, do we know how to turn it off? And do we know when we should? If you want to keep exploring how technology is reshaping the economy, money, and work, subscribe. And you're probably going to want to watch this video right here.